Good day, students. Once again, I will be recording this short question on property, plant, and equipment, where there is a change in estimate, and you are to write it in two columns: the old estimate and the new estimate. And remember, this is for tangible assets. I have done several questions on the topic of intangible assets, and I covered as much as students would need to know in those or in that topic. Now, this is tangible assets, and it says Jemmy Limited incurred an initial cost of 200,000 rands to acquire its motor vehicle on the 1st of July 2007, and this asset was ready for use on the same date. And it was ready for use on the same date. The cost is 200,000 rands. Very important to note that, and the date is on the first day of the month of July. And the fact that it was ready for use, that means when we start calculating the depreciation, we will start calculating from the 1st of July, meaning the date in which this asset was ready for use. The vehicle has an estimated useful life of 4 years. Take note of that. And a residual value of 30,000 rands. So when we're calculating the depreciation for this assets or for this asset, we know that it will be cost of 200,000 rands minus the amount of 30,000 rands, which is the residual value, and this will give us 170,000 rands. Remember, we only deduct the residual value in the case where the company's depreciation policy is a straight line method. So this is also the assumption in this case, that the company is using a straight line method of calculating a depreciation. Now it further says that on the 30th of June 2010, take note, on 30 June 2010, remember the asset was bought in the 2008 accounting period, meaning in the 2008 accounting period. Remember the 2007 accounting period. I want to bring your attention now. The 2007 accounting period ended on 30 June 2007. So on the 1st of July 2007, it was the 2008 accounting period. And I'm highlighting this because the year in this scenario or in this question is ending on the 30th of June every year. On the 30th of June 2010, so now similar vehicles of the same useful life are currently realizing at 40,000 rands, not 30,000 rands, but 40,000 rands. Now we have a change in estimate, but our change in estimate is with the residual value. Sometimes there will be, or more especially when it comes to intangible assets, you will see that the change in estimate will be based on the number of years, and at the same time the change in estimate can be a change in estimate based on the residual value, as it is the case here. Now take note that this change in estimate took place at the end of the accounting period, and I have highlighted and emphasized this under the intangible assets. But if you're starting with this video, you will see that emphasis under the intangible assets, that when the change in estimate take place at the end of the year, we always bring it to the beginning of the year, as if this must have been the case beginning of the year. That means now the change in estimate took place on the 1st of July 2009, which is the same as on the 30th of June 2009. I want to bring you, because the closing balance at the 30th of June 2009 becomes opening balance on the 1st of July 2009. So it doesn't matter which date you use here, at the end of the day you get to the same closing balance of the carrying value becoming the opening balance of the carrying value in the beginning of the next accounting period. So now that means we are now have to bring this date to the 1st of July 2009. That means the change in estimate took place at the beginning of the year, but the company was not aware of that, and they only discovered that at the end of the year, which is 30 June 2010, something that we assume that it has taken place on the 1st of July 2009. Remember, the year 2009 started, the year 2010 started 1st July 2009. That means it will be July, August, September, October, November, December 2009, January, February, March, April, May, June 2010. So now this year that end on 30 June started on the 1st of July 2009. So now that means we are to bring this date up until the 1st of July 2009. That means we need now to calculate the carrying amount from the date the asset was available for use, which is the 1st of July 2007, up until the 1st of July 2009. And we can see that this is 2 years. That means 1st of July 2007 up until 30th of June 2008. This is 1 year. Then after we say 1st of July 2008, which is just the opening balance of that closing balance, up until 30th of June 2009. This is another full 1 year. So now that means we are to calculate the depreciation for a period of 2 years from the date the asset was ready for use up to the date of the change in estimate. Remember, the date of the change in estimate, we always bring it to the beginning of the year, not to the end of the year. So now that means that the change in estimate took place on the 1st of July, which is 1 day just after the 30th of June there. After the 30th of June, it was the 1st of July 2009. So now that means we are to calculate depreciation for 2 years from the year the asset was ready for use up to the date there was a change in estimate, which is the 1st of July 2009 or 30 June 2009. Therefore, now it further says that the company's financial year is ending 30 June every year, and the reallocation method is applied. Now, the reallocation method which is applied is the one that I've provided for you in the table here. So in terms of the diagram or the table is already provided to us. Now we start under the old estimate, then under the new estimate we only start at the time there was a change in estimate. Now we say the cost on the 1st of July 2007, the cost of this asset is given to us as 200,000 rands. There were no other costs that needed to be capitalized that were not yet capitalized. So now we have nothing else to add but to calculate the depreciation for 2 years, which is the year 2008 and the year 2009. Remember, the year 2008 once again started on the 1st of July 2007. It ended 30 of June 2008. That is the 2008 accounting period. The 2009 started 1st of July 2008. It will end, or it ended 30 of June 2009. That is the 2009 accounting period. Therefore, now the 2010 accounting period starts on the 1st of July 2009, and the 1st of July 2009 is the beginning of the period in which there was a change in estimate, because we bring our change in estimate to the beginning of the year, not to the end of the year, even if the date is at the end of the year. I always want to highlight that it is very crucial to be mindful of that. So now let's calculate our depreciation, which is the cost of this asset of 200,000 rands minus 30,000 rands. 30,000 rands, remember, we are still focusing on the old estimate. We don't change that old estimate. We divide now by the number of years, which is 4 years. And fortunately, this asset was bought at the beginning of the accounting period, so we don't have to worry about the number of months. This is depreciation for the year 2008. So now for the year 2008, our depreciation, it is 42,500. Then we say obviously for the next year it will be the same 42,500. Therefore now we just say times this by 2, meaning depreciation for 2 years will be 85,000 rands. So now cost minus accumulated depreciation, it will give us the carrying amount minus 200,000 rands. This will give us the carrying amount of 115,000 rands. Take note again, this accumulated depreciation is at 30 June 2009, meaning the 208 depreciation and the 209 depreciation, which is 42,500 plus 42,500. This gives us the total of the accumulated depreciation for 2 years as 85,000 rands. So now this is where all these calculations are coming from. Now we have calculated this. Remember now, this is the carrying amount when, want to highlight that this is, let me just erase, this is the carrying amount at 30th of June 2009. This is 30th of June 2009, and we know that the closing balance at the end of June 2009 is the same as the opening balance. Take note, is the same as the opening balance on the 1st of July 2009. Hence I wrote 1st July 2009. Even if you say 30 June 2009, it does not matter for me because the closing balance is the opening balance. So now the carrying amount is the carrying amount at 30th of June 2009, which is carrying amount at the beginning of July 2009. Remember, beginning of July 2009 is the date in which there was a change in estimate which was brought to the beginning of the year, not at the end of the year. We always change the date to be the beginning of the year because we assume that this must have been the case at the beginning of the year. So now what do? We take the carrying amount at this date, we make it to be the cost price of the asset under the new estimate column. That means now when there was a change in estimate, it was on the 1st of July 2007. What is the carrying amount at this date? The carrying amount at this date, it is 115,000 rands. So we bring that carrying amount now as the cost under the new estimate. So now remember, under the old column, we don't change anything. Our depreciation still remains the same. Our depreciation for the year 2010 now, it will still be the same depreciation of saying cost of 200,000 rands minus residual value of 30,000 rands. We divide this by 4. How much do we get? We still get the same 42,500 of depreciation for 1 year, which is depreciation now for the year 2010. Then under the new estimate, now we have a new cost. The cost, which is the carrying amount in the old estimate, becomes the carrying amount in the old estimate become the cost in the new estimate. Then what do we do now? In this case, we say 115,000 rands, which we treat that now as the cost under the new estimate because the new estimate changed when the value of the asset was 115,000 rands. So we take that value called carrying amount to be the cost. We say minus the residual value of the new estimate. Remember, the new residual value is 40,000 rands, so we minus 40,000 rands. Then this gives us 75,000 rands. We divide this by the remaining useful life. I want to highlight that 37,500. Remember, in this case, this depreciation is for 2 years. This depreciation is for 2 years. If you remember, this 85,000, it is divided into 42,500 depreciation for the year 2008 and another 42,500 depreciation for the year 2009. That is the year 2009. So now this is the depreciation for these 2 years. That means out of the 4 years, 2 years is gone. So now if 2 years is gone and we say now we are in the year 2010, in the year 2010, how many years are gone? 2 years is gone. Therefore, how many years are remaining? Only 2 years are remaining because the total useful life of this asset, it is 4 years. So now in this case, there is no change in the useful life of the asset. There's only change in the residual value. So now under the new estimate, we don't say divide by 4 here after we said minus 40,000 rands. We don't divide by 4 because this change in estimate took place after 2 years. So now if it took place after 2 years, we don't take into account the years that have already passed we only take into account the remaining useful life now under the new estimate. But in the old estimate, we still stick with the total useful life. But you can also use the remaining useful life approach also when it comes to that. Now, I hope I'm making myself very clear on that. So now let us continue on that same note. We say now we have 37,500 as our depreciation under the new estimate, which we calculated by saying a total of 115,000 rands cost in the new estimate minus 40,000 rands. We get to a depreciable amount of 75,000. We divide by the remaining useful life, which is year 3 and year 4 in other words. So now it gets us to 37,500. Remember, once again, I want to highlight this is 2 years, this is 3 years, or this is the 3rd year in other words. There are 2 years is gone, this is year 3. So now how many years are left? Only 1 year that is left. So now the remaining depreciation for the future, which is the depreciation of future years, will only be a depreciation for 1 year. So now let us draw the line. Remember, after we have calculated depreciation up until the end of the year, we ought to calculate the carrying amount at that date. So now what do? We say 115,000 rands minus 42,500. This gives us a total of 72,500 rands. This is the carrying amount now on the 1st of July 2010, which is at the same time carrying amount on 30 June 2010. Remember, these are the same dates, guys, same dates. Closing balance becomes the opening balance, but we just recommend that students use the opening balance in terms of the carrying amount. But the carrying amount of 72,500 is the carrying amount at the end of June, which is the carrying amount at the beginning of July 2010. So now we are very clear with that. We go to the new estimate. Under the new estimate, we say 115,000 rands. Remember, 115,000 rands now is our cost, which was previously the carrying amount minus 37,500. And this gives us the carrying amount of 77,500 rands. Then I will say how many years of depreciation, how much is the depreciation for future years? Depreciation for future years, first of all, how many years are left? We only have 1 year left, which is the 4th year. This is the 4th year that is left, meaning only 1 year is left. So now we already do have depreciation for 1 year. Depreciation for 1 year is 42,500. And depreciation for 1 year under the new estimate, because there was 2 years left and we took into account this year, which is year 3. So now meaning only 1 year left, meaning depreciation for future years will be 37,500 because only 1 year is left. Therefore, future depreciation will be a depreciation for only 1 year. So guys, this is very much important. A very short question, sweet and straight to the point. And I hope you grab all these marks for this question. Few marks, 8 marks, 10 marks. Make sure that you take all of those marks, you put them in your pocket, and you pass the subject. And be mindful of this very important part, that at the date of the change in estimate, the carrying amount of the asset in the old estimate becomes the cost in the new estimate. Very easy. This is what is called the reallocation approach. And now, the minute you master that, then you are done and dusted with this question. Just collect all these marks as much as you can. So guys, with that, thank you very much. I hope you have understood something in this question. God be with you. Listen to the next video that I will be recording too. Thank you for subscribing also.